Welcome to the debate. You know, if you watch a modern asset price collapse on a 1-minute chart, it looks almost like a physical structural failure.
Oh, absolutely. You just see red candles cascading downward.
Right. Liquidity just vanishes. And our immediate instinct is to assume a human panic. I mean, we visualize traders sweating, frantically clicking buttons to liquidate their portfolios before they lose everything.
We completely project our own psychology onto the tape. Because a human narrative is, well, it's relatable.
Exactly.
It provides a visible antagonist, which is usually our own collective fear. But we are projecting human characteristics onto an environment that now operates in microseconds, an environment largely emptied of actual human participants.
Which brings us directly to the core problem we're analyzing today on breaking news to trading moves. In contemporary, fast-paced financial markets, what is the primary driver of execution costs and pricing anomalies?
Right. Are we looking at the psychological and cognitive biases inherent in human decision-making? Or is the market dictated by the technological friction and the latency within its own infrastructure?
I represent the perspective that human psychology, specifically cognitive bias and emotion, remains the absolute driver of market inefficiency.
And I take the opposing view. I argue that technological constraints, specifically latency and algorithmic clustering, are what actually dictate market outcomes and individual execution costs.
So, to set the baseline, from my perspective, we have to recognize that regardless of the technological advancements we construct, market movements are intrinsically driven by human cognition.
Even with algorithms executing the trades?
Yes, because we can build fiber optic networks across oceans, but the entity pulling the trigger or programming the bot to pull the trigger is a human mind carrying millions of years of evolutionary baggage.
You're referring to the behavioral finance aspect.
Exactly. The target audience here knows prospect theory, developed by Kahneman and Tversky. We all know the mathematical reality that the pain of losing is approximately twice as intense as the pleasure of gaining.
Right, the loss aversion concept.
But what matters is how that evolutionary wiring operates in a live market. It creates the disposition effect. This is the documented, relentless tendency for investors to hold losing positions entirely too long in the hope of breaking even.
While closing winning positions too quickly?
Precisely, just to secure a certain dopamine hit of a gain. When you combine this hardwired flaw with modern social media-induced herding, you find the true friction in trading outcomes. The technology is really just a faster vehicle. The flawed human driver is still at the wheel.
I approach this from a completely different angle. While cognitive biases certainly exist, operational efficiency has superseded human psychology as the defining market friction.
Superseded it entirely?
I would say so, yes. The landscape is altered so drastically that the human mind is no longer the primary bottleneck. Let's look at the operations research from Columbia Business School.
Okay.
They established that latency, the delay between a trading decision and the actual execution of that trade, creates quantifiable, inescapable costs. And that's because continuous market access is simply impossible.
There's always a mechanical delay.
Always, the researchers observed that the latency cost incurred by trading on a human timescale roughly tripled between 1995 and 2005. Today, an informational edge, like knowing the news first, is largely obsolete because information travels globally in seconds.
So you're saying speed is the only real edge left?
The ability to transmit and process orders swiftly is the primary differentiator in a 24-hour algorithmic environment. If your system is too slow, your psychological discipline doesn't matter at all.
Well, let's look at the anatomy of these abrupt price movements to see which force is actually in control. Rapid price changes and asset bubbles are driven by human excitement, fear, and information cascades.
You think it's mostly retail-driven panic?
I do. We see an influx of digital-first investors entering the market, relying heavily on social validation. They utilize arbitrary reference points, anchoring bias, like assuming an asset will return to an all-time high just because it reached that price once before.
Okay, but
Wait, let me just add, they gather on platforms like Reddit or Telegram, whipping up collective enthusiasm that drives short-term price changes completely disjointed from value. It's like a theater crowd rushing the exit,
a theater crowd?
Yeah, the panic itself causes the damage, regardless of the exit door size. The panic, the herd mentality, the fear of missing out, that is what causes the damage. The human emotion initiates the volatility.
That analogy misses the reality of the modern market, though. You're assuming that retail emotion is the primary catalyst, but the data tells a completely contrasting story.
How so?
Because the crowd you're picturing is mostly automated bots reacting to predetermined mathematical signals within milliseconds. If we look at high-frequency trading data for highly liquid assets like AMD or Tesla, and we zoom in on just a 2-second window of trading during a volatility spike,
What exactly are we seeing in that 2-second window?
we don't see the chaotic, irregular panic of a human herd. We see algorithmic clustering. The price spikes exhibit highly structured, evenly spaced peaks.
Spaced peaks.
Yes, mathematical models, specifically the power law kernel within a Hawkes process, perfectly describe this structure.
Let's break that down, because a Hawkes process is a heavily academic term. Are you talking about the self-exciting mechanism?
Exactly. Think of an earthquake and its aftershocks. In a Hawkes process, one event mechanically triggers a probability of another event in a highly predictable decay pattern.
So one trade leads to another mathematically.
Right. One algorithm places a trade, and that single action physically increases the mathematical intensity of other orders arriving in the next millisecond. As time passes from the initial orders, the probability of the next order decays exponentially.
Okay, I follow the math.
This structure strongly suggests market-making algorithms are placing and canceling orders at millisecond precision, entirely independent of human emotion. Human emotion is merely a secondary byproduct, not the root cause of the volatility.
But what initiates the first earthquake? The aftershocks are algorithmic, certainly, but the primary tremor has to be a human reaction to a catalyst.
Not necessarily.
Furthermore, even if algorithms are executing the trades, those algorithms are explicitly designed to exploit the very human biases I'm talking about. The bots might be the ones clustering, but they are clustering to extract wealth from human participants who are hitting their panic thresholds.
You think they're hunting retail stops?
Absolutely. They are engineered to hunt stop-loss orders placed by emotional retail traders.
The primary tremor is often an algorithm interpreting a natural language news headline in a microsecond, beating the human to the punch entirely. They're reacting to order flow imbalances, not human tears.
Well, if retail traders are getting outpaced by these hawkish processes, how do large institutions navigate these waters? Because if you look at institutional allocation strategies, we see that even the most sophisticated whales fall victim to groupthink, herding, and the inertia of the status quo.
They definitely have committees that slow things down.
Right. Strategic frameworks must be explicitly built to combat human flaws, not just latency.
How do institutions actually execute that behavioral check in practice, though? Because from an infrastructure standpoint, they are spending billions on fiber optics.
Look at the approach detailed by Allianz. They utilize a formal mechanism called a trade library. It's designed to force portfolio managers to find non-consensus opportunities and take the ego out of the equation.
How does it work?
For example, they initiated a relative value trade going long Australian government bonds while shorting South Korean government bonds. Why? Because the standard correlation models used by the herd had broken down, and human managers were too fearful to act against the consensus.
So the library forces them to act?
Yes, the trade library mechanism formally logs these contrarian ideas. Furthermore, they use quantitative trend signals specifically to override loss aversion, stepping into assets that human managers naturally fear after a severe downturn.
That's a rigorous process.
They even assign a designated devil's advocate during committee meetings. This is not a casual role. It is a formal requirement to actively attack the consensus thesis of the room. These institutions spend massive resources engineering psychological guardrails. That proves the true edge is overcoming human bias.
That behavioral framework is compelling. I see the merit in controlling groupthink. But have you considered that the institutional battle is actually won on the execution infrastructure?
Overcoming the latency?
Exactly. You can have the best, most mathematically sound Australian bond thesis in the world, but fast markets act as stress tests on the systems executing those trades. Platforms that function smoothly during calm, regular sessions completely freeze when volume spikes.
That's true. We see platform outages during major events.
Right. Large players prioritize co-location, physically placing their servers in the same building as the exchange's matching engine. Even a 1 millisecond advantage is incredibly valuable.
Because of the delay cost?
Yes, the Columbia University model I mentioned earlier provides a closed-form mathematical expression for this. They demonstrated that latency cost is a function of the standard deviation of prices over the latency interval relative to the bid-offer spread.
Wait, standard deviation over the latency interval. Are you essentially saying that the longer your order sits in the execution pipeline, the wider the target price can swing before your trade actually lands?
Precisely. Think of shooting an arrow at a moving target.
Okay.
If your arrow flies slowly, which represents your latency, the target has more time to move away from your aim point. If market volatility increases, representing the standard deviation of prices, the target is moving erratically.
So you missed the target entirely.
Or you hit a bad price. By the time your delayed order arrives at the exchange, the price can easily jump the bid-offer spread. Your perfect contrarian thesis just executed at a terrible price, costing you substantial capital purely because of mechanical friction.
The physics of that make complete sense. But I have to ask, does a lower latency system matter at all if the institutional strategy itself is flawed due to recency bias?
I'm not sure I follow.
If a firm is just chasing past performance or acting on panic, a faster connection simply means they execute a terrible trade faster. If the thesis is wrong because the portfolio manager is acting on emotion, the millisecond advantage is entirely useless.
Well, it matters because execution cost is a guaranteed friction on every single trade, whereas thesis generation is a game of probabilities.
A guaranteed friction?
Yes, if you are consistently losing margin to latency on every execution, your winning trades yield less capital and your losing trades cost more capital. It bleeds a portfolio dry systematically, regardless of the portfolio manager's brilliance or psychological clarity.
So let's bring these macro and institutional theories down to the individual level. We need to analyze the retail trader's dilemma and how a single human trader secures profitability in an algorithmic arena.
The retail space is even tougher.
Exactly. And from my perspective, the absolute necessity here is psychological discipline, which we can trace directly back to Stoic philosophy.
Applying ancient philosophy to high-frequency trading? How does that bridge the gap?
Perfectly, because the mechanics of the human mind haven't changed. A core tenet of Stoicism, taught by Epictetus, is the dichotomy of control.
Meaning what's in your control versus what isn't?
Right. It is the fundamental understanding that you cannot control external events, only your cognitive responses to them. In trading, you cannot control the market. You cannot control the Hawkes process, the algorithmic clustering, or the macroeconomic data releases.
True.
You can only control your entry, your position size, and your exit.
I agree that emotional control is necessary. But how does reciting Stoic philosophy practically stop a trader from blowing up an account during a flash crash?
It comes down to the mechanics of discipline and pre-trade planning. It means setting a stop-loss order before entering the trade, when the mind is calm, rational, and calculating probabilities.
Before the emotions hit.
Right. Most traders fail because they decide when to exit while the position is actively bleeding red, and their loss aversion paralyzes them. It also involves what Marcus Aurelius called the view from above.
The cognitive reframing technique?
Yes. When a trader is staring at a $500 loss on a monitor, the ego treats it as a massive immediate threat to survival. The amygdala fires.
It feels like a physical attack.
Exactly. But by zooming out, seeing that single losing trade as one tiny data point in a lifelong career of 10,000 trades, the loss loses its emotional power over the trader. The trader can cut the loss mathematically without hesitation. That internal victory over the ego is what secures profitability.
You bring up a valid perspective on self-control. But my counterpoint is that discipline alone is entirely insufficient without the right technological setup.
Insufficient?
Yes, you can possess the emotional control of a Stoic master, but if you are trading through a slow retail connection, the market machinery does not care about your inner peace. Modern brokers like ScoreCM focus heavily on reducing the mechanical delays between order placement and execution for a very specific reason.
Because they know the retail trader is operating at a severe disadvantage to the co-located servers.
Exactly. Imagine a retail trader uses perfect Stoic discipline to set a realistic stop level during a volatile news event. They have conquered their ego.
Right.
But if there is a delay in execution because the retail platform cannot handle the data surge, the price gaps right past the stop loss. The order executes far below the intended level, destroying the carefully calculated risk-reward ratio.
So you were arguing the technology outright negates the psychological preparation?
Completely. Think of it like driving a car. You can have a driver who is perfectly calm, fully rested, highly trained, and possessing perfect defensive driving skills.
Sounds like a good driver.
But if that car has a delayed steering wheel, where you turn the wheel to avoid an obstacle and the tires respond a full second later, that mental preparation cannot overcome the mechanical delay.
The driver is going to crash.
Exactly. In modern markets, trading with high latency is driving with a delayed steering wheel.
That steering wheel analogy clarifies the mechanical risk perfectly, but let me give you a different perspective to summarize my stance. Yes, the steering wheel needs to function. Technology certainly accelerates the market and creates brutal new mechanical challenges.
Right.
However, the foundational errors that destroy accounts, holding on to losing positions because it hurts to admit defeat, cutting winning positions prematurely to secure a quick thrill, and following the herd into a crowded trade, these remain profoundly human problems.
They are deeply ingrained.
They are rooted in biology. You can have the fastest execution speed on the planet, co-located servers, and zero latency, but if you lack the rigorous behavioral discipline to conquer your own cognitive biases, the market will extract your capital.
The ego as the friction.
Exactly. You cannot build a flawless machine and put an emotional wreck in the driver's seat. The ultimate friction is the human ego.
And to summarize my position, the landscape has transitioned so drastically that human ego is a secondary concern. The reality is that execution speed, power law clustering, and automated market-making algorithms now dictate market mechanics.
The machine's rules.
Yes, we are no longer operating on a human timescale. When latency cost can be mathematically proven to erode capital purely based on the standard deviation of prices over a millisecond interval, operational efficiency becomes the absolute prerequisite for success. The machine sets the rules of engagement, and if your infrastructure cannot keep up, your strategy is irrelevant.
It seems we are arriving at a point of convergence, despite our differing priorities. Operating effectively in modern financial markets requires an acute awareness of both fronts.
It really does. A successful participant must understand their internal cognitive biases, while simultaneously managing the external technological limitations of their trading infrastructure.
It's a dual mandate. You have to master your own psychology, but you also have to audit your technological execution. Neglecting either one leaves you vulnerable to the realities of a highly complex system.
It is a fascinating tension to consider, the requirement to combine ancient philosophical discipline with millisecond-level execution infrastructure. There is far more to explore within this material, but we will leave the listener to determine which friction is the most pressing for their own trading approach.
Are you the calm driver in a broken car or a panic driver behind the wheel of a high-performance machine?
A great question. Until next time, keep examining the mechanics beneath the surface.